2. Dun & Bradstreet Performance Credit Scores. Dun & Bradstreet's D&B rating. The D&B rating indicates a company's net worth range based on company financial statements as well as a company's overall financial condition. If a company's financial statements are not provided, the score is based on company size, industry, or other related factors. The D&B rating is a performance score that's based on a company's net worth and overall credit assessment. The D&B rating is broken into 3 distinct categories. Category is assigned based on the amount of information available on a company. The true definition from D&B is: D&B rating is a performance score based on a company's net worth from its financial statements as well as an overall credit assessment using information in D&B's database. Category 1 is the traditional D&B rating. Category 2 is the expanded credit appraisal. Category 3 is the alternative ratings. Category 1 is the traditional D&B rating, which reflects net worth or equity. D&B calculates this based on the company's financial statements and payment experiences or trade lines. Both must be in the report to qualify for the traditional D&B rating. Even if you have payment experiences, if no financials are present, there will be no traditional D&B rating. This score also includes the Composite Credit Appraisal Score. The Composite Credit Appraisal Score reflects an overall assessment of creditworthiness based on company payments and financial stability. If financials are not available for a company, the company falls into the Expanded Credit Appraisal category. This is based on the total number of employees for the business. If financials nor company size is available, D&B gives a score in the 3rd category, known as the Alternative Ratings category. This is based on the amount of information available in the company's report. Dun & Bradstreet's Paydex Credit Score. Dun & Bradstreet's Paydex Credit Score is the most popular and well-known business credit score. It indicates how quickly a company has paid its bills. The true definition from D&B is: D&B Paydex is a dollar-weighted indicator of a business's payment performance based on payment experiences in a company's D&B file. Another important aspect of the Paydex system of which most business owners are not aware is a Paydex Weighted Average Score. This score gives more weight to the trade accounts that report higher amounts of credit extended and less weight to trade accounts that are reporting lower dollar amounts of credit. The Paydex score is weighted, meaning the bigger the bill, the more weight it can have on the D&B score. This score gives more weight to the trade accounts that report higher amounts of credit extended and less weight to trade accounts that are reporting lower dollar amounts of credit. The Paydex score ranges from 1 to 100. Higher scores are lower risk as they predict better payment performance. Any score of 70 and higher, D&B defines as a good score. An 80 score reflects prompt payment. A score of 70 reflects payments are paid within 15 days of terms. Scores 50 or lower represent payments being made 30 or more days past terms. Business credit scores are based only on whether the business pays its bills on time. A 100 score means to expect payment may come early. 90 means payments comes within early discount period. 80 means payment is prompt. 70 means payment comes 14 days beyond terms. 60 means payment comes 21 days beyond terms. 50 means payment comes 30 days beyond terms. 40 means payment comes 60 days beyond terms. 30 means payment comes 90 days beyond terms. 20 means payment comes 120 days beyond terms. UN means unavailable. Higher scores get new business owners better payment terms, lower insurance premiums, higher credit limits. Due to these benefits, higher scores make it easier for a business to manage cash flow. Be aware that banks do pull the Paydex before lending, even though they won't send you any disclosures letting you know they did pull your score, as they don't have to. Having no Paydex score or limited credit will commonly lead to loan denial. For example, if a lender pulls an incomplete report, they typically will decline the application. But if a lender pulls a high Paydex score, the chances of being approved for credit lines from suppliers and lenders greatly increases. Suppliers and lenders can also receive updates of score changes.